everyone is short, at least from what we're seeing there. It's been one of the most shorted environments there is out there. This is why we see equities going up right now. It's just too hard for them to go down if everyone's short. How do you know a bottom when no one's left to sell? Well, if everyone already sold, the only thing they can do is buy it back.
What are the alternative asset classes besides public equities that everyone is familiar with that can generate alpha? This is the theme of our discussion with our next guest, Brian Payne. He is the chief strategist at BCA's new private markets and alternatives service. Prior to BCA, Brian served as in a number of positions, more recently the principal manager of the Teachers Retirement System of Illinois' $5 billion diversifying strategies portfolio. Brian, welcome to my show, The David Lynn Report. It's an honor hosting you. Thank you for being here.
Pleasure being here, David.
Brian, let's talk about macro first. Start with the macro overview. Now, in your new service, you discussed many different asset classes that we'll go over in detail, in particular credit, private credit. You even talked about hedge funds, so we'll get into that. But first, let's talk about long-run growth in the U.S. and inflation, some of the key themes you're focused on. How would you evaluate the growth prospects of the U.S. economy right now?
Yeah, so when we look out for our time frame, which is typically 5+ years, maybe more closer to an average market cycle, we look at growth from the standpoint of what does it look like now and what could it be once we get out in that 5 to 7 year range. And currently, there isn't much concern around growth at the moment. We look at survey data, we typically look at what is the perception of the environment at the moment. And as anyone would guess, everyone's biggest concern right now is inflation, cost of labor, quality of labor, all kind of entwined in one. But demand or growth is the least of folks' worries. So when we look at that from a mean reverting standpoint, and when you go back in history, it comes back around probably in that 5 to 7 year time frame. Again, you have catalysts in place, particularly with inflation, with the Fed juggling a lot of different things, post COVID, et cetera. But we think that those concerns or those the minimized concerns at the moment, those are going to rear their heads in the coming years here that are going to portend pretty poorly for more long duration assets. So that's why we're a little bit more negative on some of these near term. But as we get through maybe that impending recession in the coming year or two, we think growth is probably going to surface up to the main problem going forward. And then that's when we get a little bit more excited. When everyone thinks growth is a challenge, that's when we want to go into growth assets. When everyone thinks growth isn't much of an issue, that's when we don't really want to be in growth assets.
Interesting. Would you consider yourself a contrarian by that nature?
I think that's the best way to generate alpha over the long term, don't you think?
Certainly, many people would agree with you. Now, on the timing of rotation, is it generally true, Brian, that prior to a recession, you want to be avoiding risk assets, including equities, and we'll talk about the private markets, but I'm referring to public equities, and then after the recession has more or less materialized, then you want to rotate into that field. Is there truth in that?
Very much so. However, in private markets, the way you're allocating and the way investors access these markets, it is a little bit more delayed. So, for example, when you're in public markets, okay, we think risk assets are going to struggle. You just go buy or sell, your S&P, your indices, your equities, et cetera. It's just a snap of the finger. Markets are open daily. And these markets are really sourcing, you're allocating, and then the manager is putting that capital into the ground. And that's just the more common way these markets are accessed, particularly by the institutional investors. So when we think about that, we think, okay, is it going to be an interesting opportunity set that's going to open up for these growth assets in the next 1 or 2 years? And we think we're kind of close to that. However, just given where inflation is and the challenges for growth over that time frame, we think it makes more sense to be a bit more cautious as we get into that recession and see how things unfold.
Let's talk about inflation for just a minute, Brian. The CPI in the U.S. has come down steadily since its high last June. For the last 10 months, the CPI has been dropping all the way down to the latest reading of 4.9% in April. Do you think that the inflation problem, which is to say that elevated inflation, will fix itself during a recession, even if the Federal Reserve hypothetically does nothing to the Fed funds rate?
I think it's a very valid point that growth usually rolls over. Deflation comes with that because demand's getting stunted. Now, that usually occur, when we look back through history, that occurred in the GFC. Inflation did tick up, but it wasn't like it was now. We saw that in the tech bubble. Inflation really wasn't where it was now. It really goes back to the 80s. We don't really have those data points, particularly for private markets, and private markets have definitely evolved quite a bit since then. So with that said, we think inflation does prevent them a little bit from lowering rates if growth does get stunted, and growth may not get stunted enough to really have inflation roll over from, okay, 4 to 3%. Let's say it rolls over to that. That's still well above the 2% the Fed target. So we still think they'll be hamstrung. We are monitoring that pretty closely. We are looking at the month over month prints, and we do see those coming down as opposed to the year over year, where the base effects more or less linger a bit more. But we do think that it is going to stunt them a little bit from moving them down with expectations and where we've gotten over the last 2 years. Inflation was never topic of conversation when you go to the grocery store. Everyone talks about it now. Everyone knows what inflation is, and when it's deep in those expectations, and you see it a little bit in the survey data, you see it going to another level, not to the extent you may, then becomes a little bit more challenging to really zap that inflation out of the system, even with growth rolling over.
I remember in 2022 last year, I was talking to some people, and some people have told me that the Federal Reserve will need to raise the Fed funds rate to near the level of inflation in order to bring down inflation, because that's what Paul Volcker did in the late 70s, early 80s. Clearly, that didn't happen because inflation went to 9% and the Fed funds rate did not go to 9%. Were you surprised that we didn't need to have a Fed funds rate near the level of inflation, which is 9%, before we saw the CPI print go down?
No, I'm not. It's a little bit different than the 70s and 80s. Oil prices were ripping up during that time frame. They've obviously rolled over quite a bit more recently. When you're hiking rates from, what was it, 25 basis points to 5%, that's a pretty strong move right there. And over the time frame in which it was done over a year, I think it's only second to only 1980s rate hiking cycle. So the pace of which and how stark that move is something you probably do want to take a pause, see where things settle, wait for the lagged effects to get in, and then reevaluate from there. And I think we're getting to that point right now.
So bottom line, what is BCA's evaluation of inflation? Is that still a concern for investors or not so much anymore?
We've expected to come down over shorter time frames, and we've seen that, but overall remain much more elevated relative to the post GFC until really kind of 2022. Where that is it 3 to 4%? I think there's been a lot of debate around that, but I think for the most part, we see it staying above 2% for some time, especially if there's not a recession to occur in the next 1 or 2 years.
Okay. So moving on to your new service, congratulations on the launch. Once again, it's called Private Markets and Alternatives. So as the name suggests, the focus of this particular research service is to focus on anything but public markets. Why is it that investors need to be aware of and educated in this space? Brian, why can't we solely find alpha in the public arena alone?
Well, first and foremost, I would say we don't just ignore public assets. We don't hesitate to say, well, we think the public markets have a better opportunity set. Public equities have a better opportunity set than private equity. We want our clients to understand that and go after that opportunity set. So in terms of the second part, well, your question more specifically, so really since the 90s, you've seen a very interesting trend, and that's public stocks just going, public stocks, the amount of listings publicly has just been declining because more and more companies want to stay private or go private, stay private for longer as well. That creates another opportunity set by definition right there then and there itself. However, when we do look at the opportunity set for maybe larger institutions or folks that are looking for alpha, because alpha is always challenging, it's arguably finite. Sometimes I would disagree with that at times, though. But given the finite nature of alpha, finding it in more inefficient markets, and that usually comes where there's a lot of asymmetric flow of information, individuals in that market, there's high barriers to entry. That is private markets. The retail investor, while there are those products and those solutions out there to access it, there really is still a huge barrier to entry, and there's still a very asymmetric flow of information. And that's typically where you want to go enter. And that's typically the pond you want to play in to drive that alpha. And then as more and more folks get in there, as we're seeing more recently, BCA being one of them, as we're sitting here talking about the service, that alpha starts getting depleted over time, but that takes years on end. And in private markets, again, asymmetric flow of information, high barriers to entry, at least, at this point, still, that alpha is still persistent there.
So let's talk about something like private credit, which is a sector you cover. First of all, how would you define private credit specifically?
So private credit being, how would I define private? That's a very interesting question, I guess you say. Um, Loaning money out. I guess we would strike that one, but how would I define private credit? I guess what
Is
were
it
you
not
in terms of your
if it's
question?
if a corporate bond that's investable to the public, would that be classified as private credit?
Oh, okay, gotcha. Okay. So the way we define private credit are direct lenders, those originating their own loans as opposed to banks originating those loans, and they go into an index and they can trade on, the CLO, leverage loans, high yield, et cetera. They trade on an exchange, so they trade daily, lots of volume to it. In private credit, it is a direct origination. It is a bilateral transaction between the borrower and lender. Because of that, and because of the way they're structured, the way you invest in them is much different than what you'd see in public credit markets, where you're getting the day-to-day volatility. You're looking at price, you're looking at discounts and premiums. You do that in direct lending space on the secondary market, which is small and growing, but that's not really the crux of the return stream. That's not the crux of where you're getting paid back. It's making sure you're getting a good yield, making sure the borrower can achieve those cash flows to cover the repayment of such, and it's not traded daily by any means. So there is a secondary market growing, but nevertheless, it is a what I would say is a direct bilateral transaction between a borrower and lender that's not traded daily.
It says in your service you're overweight private credit overall. Can you explain your thesis?
Yeah, so when we look out over the landscape and our time frame, again being that kind of 5 to 7 year time frame, and we look at the growth and inflationary environment, and then we look at the fundamentals, which is a huge part of what we do, because again, these are very unique, very idiosyncratic assets. The fundamentals are driving a lot of it, but it's still operating in that macro environment. So while the macro environment we find is a bit challenged and you want to be a bit more defensive, we also then look at where are the fundamentals on private credit, and then we compare it to private equity, because that's usually the opportunity set investors are looking at. And from a fundamental standpoint, you're seeing yields now well into double digits. It was from LIBOR plus 300-400, you say, that's 4 to 5%, and now we have base rates up to 5%. So you're looking at double that at the moment. And then on top of that, because of where the banks have gone, because of the lack of banking activity, regulatory constraints, et cetera, we've seen them receding from the lending environment, and direct lenders coming in and really helping out, particularly private equity sponsored companies, to help them bridge the gap, to help them get to the point where they can achieve that growth and realize it. And again, you're getting paid back a lot more now. The expected returns have increased quite considerably. Most folks also think there's a huge bubble in private credit. The data just is not showing that. And when we compare it to private equity, we've seen those assets in private equity really rip up, as private credit has as well, but has lagged a little bit in relative comparison. And then when we look at private equity next to private credit, as we talked about before, we just think it's a bit more challenged from a growth standpoint. The fundamentals on private equity, because the amount of capital coming in there, particularly post 2020, has pushed valuations up to historical extremes. Those cash flow expectations we think need to come down because of the expected rise in inflation in 2022 and the challenges ahead for that. So when we look at it from both angles, the top down and bottom up across private credit, private equity, we think private credit has a really nice runway, and really at the expense of private equity, where there's going to be a lot of struggling there with the rising cost of capital and trying to get to that point where they can achieve growth again.
What are some direct ways that investors, either on the retail or institutional side, can participate in the private credit market?
So private credit's most often accessed via what you call closed-end funds. These are drawdown vehicles as opposed to a mutual fund or open-ended fund where you allocate your capital and it immediately gets put to work, all the capital right then and there. When you're in a drawdown fund, you're allocating capital. There's usually a 2, 3, 4 year time period where that manager is allocating that capital as the opportunities come. So it's really building up the opportunity set. And then after the end of that investment period, it's what you call the harvest period, which is usually about the same length and maybe a little bit longer, where they're starting to, as the name implies, harvest those gains. Capital's coming back. You're looking to exit these companies if you're on the private equity side. So those vehicles can typically last, 5, 10, even up to 15 years at times. But then on the other end of the spectrum, and this is the institutional side, you can look at the secondary market where those opportunities can come very quick. You can look at co-invest structures where you're looking at a specific opportunity, and over that time frame, it's you're just allocating that money. It immediately goes into that opportunity. That is harvested. That's usually a 4 to 5 year kind of time frame, depending on what asset you're looking at. So those are a little bit of shorter duration versus those drawdown vehicles that I just talked about. So that's the typical way an institution accesses it. On the wealth management or the retail side, this is one of the big challenges wealth managers do have is meeting those minimums, because when you're at an institution, you're allocating hundreds of millions of dollars in capital. You're really meeting those minimums that are 25 million. But if you're on the retail side, even if you're high net worth, you're aggregating this capital, and it's still a challenge to meet those. So a lot of vehicles out there I would suggest for the retail crowd are what you'd call BDCs. I look at them myself. They're publicly traded, so they do have those daily marks, but they are access into private credit loans. And the big names out there, the KKRs, the Blackstones of the world, they have these vehicles. Now, they are on the secondary market, so they do trade at discounts and premiums. And I would suggest the retail crowd really understand that. But that's really the best way in which to access them. And then over time, we expect more and more vehicles to come out, especially as wealth management has gotten way more interested, particularly private credit, in accessing these structures.
What is your expectation for interest rates, in particular pertaining to private credits, and how interest rates will affect this sector?
Yeah, so in private credit, and we break it down by sub asset class, and that's how we do our analysis. I would break it down just for the two ones that you want to talk about is senior debt and then mezzanine debt, which would be subordinated. Now, in private credit, similar to leveraged loans, it's more floating rate, particularly for senior. So it's an LIBOR, SOFR now, plus whatever it is, 300, 400 basis points on top. So in a rising rate environment, as these floating rate instruments reset, the lender is going to be getting paid back a lot more. So when rates are going up, that's typically a pretty good environment for floating rate notes. So senior debt. When rates are going down, it's a little bit better for fixed rate. So if you're subordinated mezzanine, typically high yield bonds, these are typically fixed rate. So as rates go down and you're locking in a 10% rate, and then rates go down from 5% to 2%, that 10% really comes 7% or even lower. So you locked in that 10%, that 10%. So the fixed rate structure is typically going to have a better runway there. So the way we look at it with interest rates going forward, to your question, is they've risen quite a bit. We don't expect them to go down precipitously over the coming years. So even the floating rate notes are going to have a better outlook. It still have an improved outlook, but we tend to be a bit more on the fixed side, especially in the subordinated side of things, because of that interest rate outlook.
I'm curious to understanding your hedge funds strategy here. So I'll just read a paragraph from your service here, from your report. It says, while we are generally positive on hedge funds, it is important to keep in mind the significance of manager selection in this arena. Strategy implementation and skill, not asset ownership, i.e. beta, ultimately drive the outcome. So how is it that you determine manager skill, and how is it that you select hedge funds?
Yeah, hedge funds are a very unique asset class, I'd say. They're really not an asset class. It's a structure in which you're accessing manager skill. And then there are times where you're just accessing, credit or equity, et cetera. For example, a long short equity manager, they're long and short stocks, but maybe they're running with a 50% net. So when stocks go up, they typically should be going up and getting paid for that because they're holding a beta, vice versa on the way down. Structured credit managers, you're holding credit, you're getting paid back. So you are getting that premium. But for the most part, hedge funds vary in all different types. And the way we organize is directional, diversifier, risk mitigation, directional being long, short equity, event driven, diversifiers being those macro multi-strats that really have no beta to them. And then risk mitigation, which are your typical kind of hedge fund structure that are trying to generate return when markets go down. So understanding that from the get-go, let's just take macro, for instance. So if you're a macro manager and you think there's a good runway, which a lot of volatility, rates are going up, 2022 was one of those runways, was one of those great backdrops. However, you could have got the macro call right, but you could have been in a manager that was down 20% as opposed to a manager that was up 20%. Now, it's very similar in, say, private equity, real estate, private credit. However, it's not at the dispersion is not as much, meaning you could have a manager in private equity achieving 15, 20%, and that's a good one. And then a bad manager achieving, maybe 10%, maybe, high singles, but that's not negative. So you're just missing out on a bit return. In hedge funds, you can be losing money because of the managers you're picking. And the reason we emphasize that is because they're all used differently within individuals' portfolios. So, a macro manager may be positioned to really be good at capturing the downside really well, particularly in a 2020 environment. But other folks might use a macro manager to really try to beat the equity markets. And we've seen a number of these generating really high volatility, trying to generate an absolute return, but they're really just trying to hit huge numbers, huge absolute numbers out of the ballpark to beat the equity market as opposed to diversifying. So the way they're structured, the way they're used is much different by everyone. And you need to evaluate the skill of those managers because that's the most important driver of the success of that structure is the manager and the team of that manager.
Of the hedge funds that you've analyzed, are there any commonalities in their shifts in strategies given today's macro environment? I understand there's many different types of hedge funds with varying strategies, but is there something that everyone is doing now that maybe they weren't doing a few years ago?
Sorting. So we've talked, this has been a pretty interesting topic, particularly in the meme stock era, which you could probably define January of 2021. I recall that environment quite well, actually. Almost every long short equity manager got dinged pretty good there. So following that environment, because of meme stocks, because of the amount of liquidity out there, the retail involvement within these spaces, a lot of managers shifted away from the single stock shorting going into indices because you don't want to be blown out on one of these stocks that, one of those funds ended up going under because of that. They just could never recover. So that's something we're seeing recede, especially after a year like 2022, less retail involvement in the markets. The short interest coming down as well, particularly from that crowd, although they're still using options here and there. So when these managers were using ETFs and using indices, you're not really generating a lot of short alpha. We see that coming back into the fold. And then also on top of that, because a lot of these managers struggled in the equity long short space in 2022, seen a lot of capital come out. So when there's a lot of capital coming out, less capital chasing those opportunities, we just like it a lot more. And we see that going forward. And when you compound that with the fact that the short side looks a lot more interesting, something that was a much more of a challenge in 2021. And then, now it's not going forward. We really like that space. And we think that's a pretty big difference from, 2 years ago.
Interesting. If somebody were to give you a brand new hedge fund that perhaps you've never heard of and to ask you to evaluate its performance and whether or not you would consider investing in this hedge fund, what are the first metrics you would look at to make this evaluation?
I look at how they navigate volatility. So the way we position hedge funds from what I've done before, and again, they're all different, but for the most part, they're supposed to be there to diversify. What are you diversifying? Equity risk, because most of your portfolio should be in growth assets. You want to make money over time. But then there are times like last year, maybe the environment we're kind of getting into where they might not be down, but they're not generating a lot of return. So in those types of environments, you want to find folks that navigate volatility pretty well. So what I mean by that is, okay, like 2022, markets are down 20%. Well, if that manager's down 5 to 10%, running a net of 50%, that's pretty good. So then when markets do come back around, you're in a better point of strength to then capture that upside again. So we want to look at how they navigate volatility, not just in absolute terms, but relative terms, what kind of asymmetry they're generating. And then that would lead us to question, well, how did you do this here? Why would you say that is repeatable? Because that's one of the main things of hedge funds you want as an investor is it repeatable again? So that's what we'll spend a lot of time is how are you navigating those volatile periods? How are you diversifying the rest of our plan or portfolio, et cetera? So that's the number one thing we look for when we do look at hedge funds initially.
The best hedge funds in the world, what are those managers doing, or how are they thinking that separates them from the rest of the crowd?
So I'd say it's three things we look at. The process. So process is very important. We don't think it adds as much alpha anymore, just given technology, AI, et cetera, but very important because you need to have that process and it needs to be repeatable. The other two ones, risk management and portfolio construction, that's where that cleverness comes in. That's where that uniqueness comes in. Everyone can own Apple, but are they owning it and what kind of quantity? Are they long, short it? How are they constructing it with the other parts of the portfolio that when their conviction is wrong or when they're wrong on certain calls, how's the other side of the portfolio kind of balancing it? And that's the beauty of it. That's where that art comes in. And that's where the alpha is going forward is in the portfolio construction. And then risk management is very similar is how you kind of pulling those levers within portfolio construction. How are you limiting your wrong, how are you limiting your wrongs, how are you maximizing your rights? So that's how, that's really where that alpha is coming in going forward here.
Have you noticed an increase in shorts in a particular sector from hedge funds recently?
Well, I think you've talked about it before in some of your shows is the amount of short interest on the S&P, particularly E-minis, and it's just a sample size when you look at CFTC data. Everyone is short, at least from what we're seeing there. It's been one of the most shorted environments there is out there. This is why we see equities going up right now. It's just too hard for them to go down if everyone's short. How do you know a bottom when no one's left to sell? Well, if everyone already sold, the only thing they can do is buy it back. So that's one of the things we see out there. And then I think another one you pointed at was the short interest in shorting U.S. 10 years. So everyone still thinks rates are going up, which, they could be, but we don't think that upside or we don't think that risk is still there to be shorting like they are. So you're seeing a pretty lopsided market right now in terms of positioning. That we'll see how that plays out. But if everyone's short equities and everyone's short rates, the opposite's probably going to occur at least in the next 6 to 9 months, and that gives us a little bit. That gives us a little bit of concern for more of the macro managers, some more of the short interest, the hedge risk mitigation strategies. And that's why we do like those equity long short managers, is even those betas are going to carry them up as equities kind of melt up a little bit.
Given what you just said, I'm guessing you're leaning more on the long side of things. If you were to invest yourself, you were to bet on the S&P going up before a reversal. Is that a fair assumption to make, Brian?
I am long the S&P and I'm lever long the S&P, at least over the next few months.
All right, fair enough. Is there a particular, I guess, inversion point or catalyst that you would be looking for before you change your mind?
Well, similar to like we talked about earlier in the show, I'm waiting for everyone to get extremely positive. And anytime you talk to someone out there, and whether it's our clients, other investors out there, when everyone says we're long equities, we're very positive, that's when it will probably roll over. Whether
I
that's
was
this year
see
or early next, we'll say.
somebody tweeted that it came up on my Twitter this morning. It was a collection of news articles from various financial media about how the bull market is back because the S&P's already risen 20%. Not everybody is bullish, but certainly we're seeing that reappear in the mainstream media. Are you seeing more of a mix in sentiment, or like you said, most people you're talking to are leaning more towards the bearish side?
You are seeing a mix. I've seen a lot of a lot of macro managers more recently, particularly ones that are probably flattish on the year, aren't as deep into the negative territory, starting to build those short positions back up, given more recent pricing. We think that's somewhat of a mistake, just given, again, how short the market is, where sentiment is. Yeah, those stories are coming up, but it doesn't mean folks have acted on that. It doesn't mean those flows have come or are already behind us. We expect those to start coming, especially with those stories and those headlines from the retail sector. When my friends start calling me up and saying, when should I start selling stocks? Well, then we'll kind of start talking.
All right. Finally, Brian, is there a dominant investment theme that fund managers are paying attention to? Is it something to do with the macro? Is it something to do with tech? Is it AI? All of the above? None of the above?
Well, I could sit here and talk about AI, but I think everyone already does that. I think one of the more interesting ones, particularly as it relates to private markets, is gaming. So gaming is an interesting theme we have for early venture capital. That's why we're somewhat neutral on early venture capital, given the resetting, repricing, and what the environment we're going through is a little bit different than the last one. So this is a good starting point. Gaming is going to be very interesting, especially as AI continues to come in the fold, especially as unfortunately it's going to be taking jobs. what are these people going to be doing? They're probably going to be gaming. I know that's kind of a rudimentary way of looking at it, but we've seen a lot of interesting activity on the early VC side in gaming. And of course, AI is helping that too. With those gaming systems, I'm not one who ever played video games, unfortunately or fortunately, so I can't go too deep there. But that's a very interesting theme we're monitoring at the moment that I don't think is getting a lot of coverage.
Okay. And generally speaking, the VC space, is that slowing down or speeding up?
Well, after a year like 2022, I think people have put the brakes on there. We continue to be a little bit more negative on late stage venture capital, given the cost of debt, the rising cost of debt, the lack of available credit out there, post Silicon Valley Bank, et cetera. Early stage VC, we just think is a nice reset and a very interesting time to be finding those unique ideas as we start going through the post COVID environment that really took hold. Kind of after that last wave in early 2022, we're finally settled into it, and this different world is where you want to start looking for different types of technologies and different opportunities in the VC stage space. Early stage VC has that.
A final question, Brian. This has been a fascinating talk, so thank you. Is there a particular technological breakthrough that you would personally want to see that would reinvigorate interest in not just tech investing, but tech overall? Take Apple, for example. They just released their VR goggles, and I was reading the news that this is their first new technological innovation or introduction in their product line for more than 10 years, I think. So certainly we're not seeing, I'm not saying innovation has stalled. I'm just saying certainly the marketplace has noticed that the pace at which new types of products is being released has slowed down over the last 15 years.
Yeah, I expect that to continue a little bit. However, from the answer to your question, I don't think I can point to a particular technology, but I will point to VR headsets because I was looking at that this morning. I'm
Yeah.
probably going to take the short side of that. I don't know how many people want to sit and hang out with a VR headset, on their head all day. So I might be on the short side of that one.
It's also $3,000, so I don't know. Well, I'll personally wait for that price to come back down a little bit. All right, Brian, where can we learn more about your work and BCA's work?
So visit the BCA Research website. It's pretty well laid out there. I would point to that. Um, and yeah, go to the BCA website. Everything's there for you.
All right, we'll put a link in the description down below. Thank you very much for your time today, and best of luck with the new service.
Thank you, David.
And thank you for watching. Don't forget to subscribe.